Hi, welcome. Thanks for watching and I appreciate you being here. This video today is about mutual funds and ETFs. More specifically, the difference between the two and why I personally prefer to invest in ETFs. In this video, I'm going to define both mutual funds and ETFs. I'm going to do a detailed review of the major differences between the two, and then I'm going to offer up my conclusions. And finally, as I like to do, I'm going to provide some references, some sources, and additional information that you might be able to use to do your own research and make your own decisions regarding investing. Before we get started, here's a little bit about me.
Hi, welcome to my channel. Thank you for watching. Here's a little bit about me. My household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. We live in a high cost of living city in the Northeast. My husband and I both went to graduate school, but fortunately, we no longer have student loan debt. I work in banking and he works in aviation. I take care of the family's finances and I love my role as the self-appointed CFO. I love to talk about all things money, whether it's investing, saving, or making money. I look forward to sharing a wealth building journey with you. I look forward to getting to know you, and I hope you enjoyed this video.
What are mutual funds and ETFs? Let's start with mutual funds because they really are the original. Mutual funds are a pool of investable assets that are managed by professional advisors. When you invest, what you're actually doing is you're buying a part of that fund manager's portfolio, and your own performance is going to reflect that of the managers. Mutual funds have different types of characteristics based on a collection of underlying securities, their objectives, the type of returns that they give you, etc. Here's what I mean by that. Mutual funds are categorized by the type of asset that they hold. When I'm talking about underlying securities, I mean stocks, bonds, and commodities. To get specific examples, you can have a mutual fund that gives you a total US stock market. That's the underlying security, and that is the type of asset that it holds. VTSAX is a popular one that you might have heard of or that you might yourself be invested in. That is the Vanguard US Total Stock Market Fund. You might have bonds in your mutual fund. There are different kinds of bonds. There are US bonds, there are international bonds, and there are world bonds. If you want to look up a ticker for a bond fund, you can look up BNDW. That is the Vanguard Total World Bond Fund. Commodities is another type of securities and underlying assets that can be found in a mutual fund. Some mutual funds invest in gold. If you want to look up a mutual fund that is invested in gold or other type of commodities, you can look up OPGSX. That is a ticker for a gold fund. Mutual funds can also be divided by sectors. Not just what type of assets that it holds, but also what industries that it invests in. You can look at real estate, you can look at energy, you can look at technology. Mutual funds can be invested based on location. If you're looking at just the US, I already gave that example, the US total stock market, but you can also look at all stocks outside of the United States. A mutual fund can follow an index, either the S&P 500, the Dow, NASDAQ, or even the Russell 2000. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. There are mutual funds that are based on certain specialties. For example, responsible investing, people who are into ESG investing. ESG is an acronym that stands for environment, social, and governance. These are the types of funds where fund managers try to stay away from investing in companies that either have controversial products or services. For example, they might not invest in companies that manufacture guns, or companies that have a history of human rights abuses, or companies that are known to pollute the environment. It's all about personal decisions. There really is the opportunity for you to find a mutual fund for almost everything. Mutual funds are not free because they are a slice of a portfolio that is being managed by somebody. They have fees that are called expense ratios. That's how managers make their money. The fees vary widely based on the company that you are investing in and the investment style. A fund that is invested in an index is going to be much cheaper because there isn't a lot of work for the fund manager to do. You're simply paying for the access. A fund that has active investing is going to be more expensive regardless of what broker you go with. The fund manager is putting more effort and more brain power into shaping the portfolio to be a specific way. They are going to charge you more for that. And there are simply companies that really just charge you a lot because a low fee model is not necessarily part of their company values. Part of the reason why Vanguard is very popular is because they have popularized low fee investing and has made it accessible for a lot of people. Not every company is like that. Not every fund is like that. When you have mutual funds, you make money like you would make on any other investment. You make money through dividends and you make money through capital gains. Capital gains is when you realize the gains after appreciated assets are sold. But now that we talked about mutual funds, let's talk about what ETFs are. An ETF is an exchange traded fund. They really have the same features as mutual funds, and they do almost all the same things that mutual funds do. They operate very similarly with a pool of investment, and it's categorized by the type of fund, but it differs in some other ways. One of the key features of ETFs is that ETFs are very similar to stocks in how they're traded. They are traded on stock exchanges and they are bought and sold at any time throughout the day. That is unlike mutual funds, where if you put in an order for the mutual fund, it doesn't go through until the next day and the price really doesn't update until the end of the night. ETFs also tend to have a lower expense ratio because the fund managers can automate more of the work. I just mentioned some of the differences between ETFs and mutual funds just now, but these are not necessarily the most important differences. Let's take a look at the much more important differences that might sway you one way or another. I have listed here 7 key differences between ETFs and mutual funds. The first question you have to ask yourself is, which investment option is more portable? Portable is the ability to move from one brokerage to the next. Some brokers may not allow the buying and selling of some mutual funds, or they may not allow a transfer in kind. You can buy and sell on their platform, but you can't transfer it from another broker. You might be in a position where if you are unhappy with your current broker, you might have to sell, transfer the funds, and then repurchase those shares. As I already mentioned, because one of the features of ETFs is that they are traded like stocks, almost every mainstream broker is going to allow a transfer in kind. And for that reason, ETFs are much more portable than mutual funds. Next is tax efficiency. Tax efficiency is when you make sure that you're paying the least amount of taxes required by law. Unlike mutual funds, ETFs rarely expose investors to capital gains. And when you have capital gains in a non-tax advantage account, either a retirement or a 529, those gains are taxable. Unlike ETFs, mutual funds have to buy and sell underlying securities in order to fund normal portfolio movement. Whereas for ETFs, mostly dividends are going to be the source of your tax draft. As a result, ETFs are much more tax efficient than mutual funds. I don't know if you've heard about it. There is a class action lawsuit against Vanguard. I will be posting the link in the description box. Vanguard made some changes to some funds that triggered a lot of investor activity. In order for Vanguard to redeem those shares for those investors, they had to sell a lot of their assets, and that generated a lot of capital gains, which got passed on to the investors. People with funds who were in non-tax advantage accounts had to pay massive tax bills that they were not necessarily expecting. As a result, there's now a lawsuit against Vanguard. It is still in progress. We don't yet know the outcome at the time that I'm recording this video, but this is an example of the kind of issues that you might have if you have mutual funds in a non-tax advantage account. Next, you have to determine which fund costs are better. The cost of your fund is going to be your expense ratio. It is how managers get paid. Because ETFs can be automated much easier and they have less movement, they typically are less expensive than mutual funds because mutual funds have more work involved. That also means that the vast majority of the time that ETFs are going to be much cheaper. We need to consider commissions. Which type of investment has a more favorable commission structure? Commissions are different from expense ratios because they are not an ongoing fee that you pay, and the total fee is not based on the size of your portfolio. Rather, it is a one-time fee that is paid to a broker when you make a trade. Typically, mutual funds are proprietary to a particular investment company. They are branded. If you invest with that brand, you typically don't have to pay a fee. For you to invest in that investment company, but with a different broker, they will charge other brokers for that broker to have access to those funds. For example, if you want to buy Vanguard from a Fidelity account, the odds are you're not going to be able to buy it for free. Whereas you can buy Fidelity funds for free from Fidelity, or you can buy Vanguard's fund for free from Vanguard. The mutual fund commission for holding a mutual fund that is related to that same brokerage, that same investment company, is typically going to be $0, but they really can be as high as $50 or $70 if you hold a particular brand at a completely different company. The only time you're going to get a $0 commission trade on a mutual fund is if you're trading with that particular broker that has branded the fund. And that is different from ETFs, which, because they trade like stocks, you're only going to be paying in commission what the broker charges you. And since most brokers these days are doing $0 trades for stocks and ETFs trade like stocks, you can buy and sell the ETF version of a mutual fund with any broker for next to nothing. The next thing we need to consider is barrier to entry. How high is the initial minimum investment requirement? For mutual funds, it does vary. It varies by broker and it varies by fund. It could be as low as $500. It could average out to about $3,000 for an initial investment, or it could be as high as $50,000, depending on what kind of fund that you are looking to invest in. Typically, going forward, you are allowed to invest whatever amount that you have, but in order to get your foot in the door, you do have to have a minimum. ETFs, on the other hand, they tend to trade for nothing more than the price of the stock. That means ETFs have a lower barrier to entry because as soon as you have enough to buy your very first stock, your very first share, you are good to go. Another difference that people might want to consider between mutual funds and ETFs is the ability to trade fractional shares. Being able to trade fractional shares is your ability to buy the fund to the dollar. ETFs trade like stocks, and as a result, most brokers do not allow fractional shares unless it's a dividend reinvestment. On the other hand, almost every broker that I have been with has allowed me to purchase a mutual fund by the dollar amount, not by the share amount. The good thing about that is that there is no cash drag. You don't have an extra $5, an extra $10, an extra $20 just sitting in your account doing nothing just because you didn't have the exact amount as the price of the stock or the ETF was moving. At this time, I'm only aware of one broker that allows fractional share purchases of ETFs, and that is Fidelity. And because of that, we can finally get a win in the mutual fund column. In this case, the mutual funds win because you can always buy it down to the penny. And last but not least, which one offers you more options? ETFs definitely do not have as many options as mutual funds. Mutual funds have more types of funds. For example, they have more actively managed funds. I don't know if that's a good thing because they don't always beat the market and they charge you higher expense ratios. But they also have other types of funds that you're not going to find in ETFs as easily. An example is target date funds. Target date funds are not necessarily controversial, but they're really hit or miss. They are not a good fit for everybody. And I am planning on making a separate video about target date funds. But this is certainly an area where mutual funds are going to win because you're going to have way more options that you're not necessarily going to find in an ETF. Not that they don't exist, but they are far and few in between. So in conclusion, in my opinion, all things being equal means that ETFs win. I find them to be far superior for the following reasons. First, I don't want to be tied to a particular broker. Certainly, nobody's going to force you to stay with a broker that you don't like. You are free to leave at any time, but not everybody allows you to transfer in without having to sell your shares first. And if those assets are being held in a taxable account, you could potentially incur taxes if you realize gains. And even if you are able to do an in-kind transfer of all your securities, if you want to add to your position going forward, or even if you want to sell them, you might be paying substantial fees. I also want the cheapest fund possible. Why should I pay more for something that is very comparable or that is mimicking the same performance? If you have a mutual fund and you have an ETF where the ETF has the exact same performance and it has the exact same underlying securities, I really don't have a reason to be paying more, and I don't want to. As you know, when it comes to wealth building, it's not just about how much you bring in, it's also how much of your money that you keep. Over time, it does add up, so I want the cheapest fund possible. I also want to avoid capital gains whenever possible, and that's exactly what I was mentioning earlier when I was talking about being forced to sell if you're going to another broker. And reason number 4 why I think it's a superior option is that it has a lower minimum investment. Certainly, I don't have any plans right now to change my asset allocation or to necessarily rebalance. I don't foresee myself selling securities in order to buy different kinds of securities, but I like to keep my options open. If I ever wanted to switch or if I ever wanted to buy a different type of index fund, I would like to know that I don't necessarily have to have $3,000 to $5,000 on hand. I would like the ability to just buy what I want to buy or what I can afford to buy. And knowing that I can buy for just the price of one share is more comforting, and that is a more favorable position for me. It doesn't mean that there are no downsides to ETFs. Mutual funds do offer more options. These are not necessarily required for my personal investment goals. There is a total stock market ETF, there is an S&P 500 ETF, there is an international ETF, and currently these types of funds are the kind of funds that meet my needs. The ones that are lacking are most certainly unfortunate for people who would want to have those options, but because I don't need them at this time, I don't really mind those downsides. Another downside that I mentioned is fractional shares. It is a bit of an annoyance for me to see those small dollar amounts in the cash position in my portfolio. My inner symmetry lover certainly would have loved to see my cash be at zero and all of my money invested into the market down to the penny, but that's more of a nice to have. It's not required. To me, it is not worth the downsides of mutual funds. It bothers me, but not enough. So here are some additional sources of information. I am going to link them in the description box below. The first link is the Vanguard class action lawsuit. You can read more about it. And then the second one is the Vanguard target date fund change announcement that resulted in that class action lawsuit. As I already stated, I am working on a video on target date funds where I will be touching on this a little bit, and I hope you'll check it out. If you haven't done so already, give this video a thumbs up. And of course, subscribe and turn on your notifications so you can get a heads up when I do post that video. And of course, before you go, I want to hear from you, whether you want to make a video response or make a comment below. Let me know, what do you invest in, mutual funds or ETFs? Which one do you prefer and why? If you don't have a preference, does this video sway you in any way? Are those differences that I listed enough for you to make a decision? Certainly, I don't claim to be a mutual fund or ETF expert. I may have forgotten something. If I missed anything, any major differences that you think are relevant that I didn't bring up, let me know as well. I look forward to hearing from you, and I will see you in the next one.